Really pleased this morning to have Jamie Ross and Tom O'Hara from Henderson, co-managers of Henderson European Trust. Henderson European Trust came into existence this summer with a combination of two stablemate European equity trusts, Eurotrust and European Focus, and this wasn't just a combination of financial assets, but a combination of two fund managers who both have respective track records of outperforming the same benchmark. I have had a preview of their presentation, and I'm resisting the urge to steal some of their best lines. So I'll just say that they present a really convincing set of arguments for why investors should be paying attention to Europe. But before I hand over to them, just very quickly, for those who haven't attended one of these webinars before, you'll see there's a box on the right hand side where you can put questions. You can submit those whilst they're presenting. I'll be reading those. And also if there are any support issues, you can put those into that box as well, and someone will try and help you. There will be a recording of this for you to look at later, and you can download the slides along with that. So with that tiny bit of housekeeping, I'll hand over to the team.
Thanks, Alan. Good morning, everyone. So I'm Tom, and Jamie is the other guy who's not speaking at the minute. I'm going to kick us off. A little bit of housekeeping from us, perhaps. We'd love for this to be an interactive session. So do please ask questions. Do please hurl as much abuse at us as you would like. And hopefully it's a productive and informative session that will leave you a little bit more reassured on the prospects of investing in equities in Europe. You know, that's the biggest question we often get, especially from the global asset allocators, is why Europe? I'm not going to steal Jamie's thunder because he's going to talk about why Europe. So I'll kick off with a little bit about who we are. As Alan mentioned, we're a fairly young entity in its current guise, with a combination of two very long-standing entities that were Henderson European Focus Trust, which I managed, and before me it was John Bennett, a veteran European fund manager, and Henderson Euro Trust, which was Jamie Ross, and before him a guy called Tim Stevenson. Now, on balance, you could say Jamie used to invest in stocks that grew a bit faster, whereas Henderson European Focus Trust, on balance, had a little bit more taste for some of the value opportunities, you know, some of the cheaper stocks that we felt were a bit overly punished by the market. But that's on balance. More importantly, I think, for why we saw fit, why the board saw fit to combine these two entities, one was related to the investment company landscape. These two trusts, they were sat just under about 400 million sterling each, had both become incrementally more illiquid in terms of two illiquid gateways to what is actually a relatively liquid universe in which we invest. And so by putting these two vehicles together, we're bigger, we're better, we're more beautiful, we're more liquid. On top of that, Jamie and I have sat next to each other for many years now, and we've got a great working relationship. So by combining our efforts, we think we come out with what we've called on the title slide a flagship product for the Janus Henderson European equity team. We work day in, day out, always debating, always rubbing each other when stocks we like are down, but also congratulating each other on a job well done and certain stocks are going up. But it's a really good dynamic, and we're part of an excellent European equities team here at Janus Henderson, which also is instrumental in delivering performance on the trust. And in fact, there's the track record over a 10-year period. We've consistently outperformed the market, and it's thanks to the entire team at Janus Henderson, specifically the European equity team. And we'll come on to this more, but effectively what we are is a fund that invests in 35 to 45 stocks, the best ideas that we think are there to be invested in right now in Europe. And again, you'll see that we pepper our presentation with a series of phrases, one of which is global champions. It's no secret that Europe, from a societal, from a political, from an economic standpoint, has challenges. We've got poor demographics. Most countries in Europe don't make enough babies. That's a driver of GDP growth. Most of the big economies in Europe, with the exception of Germany, have got high public debt levels. We've demonstrated as a region GDP growth well below that of our more innovative cousin across the Atlantic, which is the US. But despite all of that, European equities, and especially when you invest actively in specific stocks, European equities can really offer sound returns, promising returns. And actually, if you look since the beginning of 2021, there's been quite a stark divergence between the performance of European equities as an asset class and the underlying economic growth of the continent. GDP growth since the beginning of 2021 is basically flat, as in there's been no economic growth. And yet European equities on a benchmark level, so before any outperformance that we can deliver through active management, European equities as an asset class are up 30% plus. That's telling you that there's a distinction between European equities as an asset class and Europe as a region, as an economy. And that is the fact that so many of the companies we invest behind are global. They may be listed, they may be born in Europe, but they're global and they benefit from global themes. So that's why you'll see terms like global champion. With that, I'll hand over to Jamie.
Thanks, Tom. Hopefully you can hear me all. And I'm going to now touch on why Europe. Now, ever since Tom and I started with, incidentally, Tom, if you flick on to the next slide, actually, ever since we started, and this slide really covers the entirety of our career, we've been accosted by investors for why should we own Europe? What is the point in owning Europe? The US just does better. The US market is a better market. The US economy is a better economy. US companies are better. There's always been this insinuation that Europe doesn't have interesting companies. There's no tech in Europe. There's no interesting innovation in Europe. Anything that's happening is happening in San Francisco. It's not happening in Amsterdam. The reality is very, very different today. So yeah, 20 years ago, Tom and I probably had to justify the market that we could invest in to some extent. Now I find that justification and explanation so much easier. Europe has been through a purge. Europe has been through a changing of the guard. This is a different equity market today than it was when Tom and I first started. And you can see this in a number of different ways. So one of the things we would look at is look at the concentration of the index. And when I say index, I mean kind of, pan-European indices. So all of the companies that Tom and I could invest in, continental European indices, all the companies we can invest in across Europe. If you look at the top 7 names in the index today, that accounts for about 20% of the index. Going back to the start of Tom and I's career, that was 11 companies made up the top 20. So it is more concentrated, and it is more concentrated in better industries, better thematic growth opportunities, better companies. You know, let me give you some examples just to bring this to life. You know, some of the biggest companies when Tom and I first started in Europe were the telco companies. You know, that for us is largely a pretty commoditized, low growth, price taking industry. You know, these aren't brilliant businesses. They made up a big portion of the index. We have to look at these companies. They're not great businesses. Santander, a Spanish bank, was right up there in some of the biggest businesses in Europe. Bayer, some of you guys who have invested in Europe will know from painful experience what it's been like to invest in some large German conglomerates such as Bayer or Siemens. You know, that these businesses dominated the indices back in the kind of global financial crisis era. It was banks, it was telcos, it was bad businesses. What have those companies been replaced with? When I talked about the concentration of our index, what's it been replaced with? Some brilliant businesses. You know, so semiconductors, for example, now make up 6% of the indices. So 6% of our index is involved in facilitating and driving the movement towards AI, the movement towards machine learning, the inevitability of the tech revolution, the wave of tech that we're going through at the moment. Some of the facilitators are sitting in, I mentioned Amsterdam, they're sitting in Amsterdam, they're headquartered there, some brilliant businesses. What else have we got? Novo Nordisk is a great poster child of success in European innovation. You know, it is not only tech companies that can innovate. You know, Novo is a brilliant example of a business that has been innovating for 100 years. Novo's been around 100 years. European companies have this heritage, and Novo's been doing exactly the same thing for 100 years. It was originally founded as an insulin company. That's pretty much what it still does today, although a lot of us will know it better for its tilt towards obesity, which, you know, very clearly is a problem, a global problem, societal problem, an economic problem, a problem that is as yet without a solution. Novo are providing that solution, and it all comes from 100 years of innovation in diabetes, in insulin. So some brilliant companies. SAP, another great example, a business that has been around for a long time, but a business that powers every company we look at pretty much, an enterprise software company. So the accusation that Europe doesn't have innovation, doesn't have high quality businesses for us to invest in, that is an argument for yesteryear. You know, that is an argument for 20 years ago. You know, Tom and I are very excited by the universe that we can invest in. It's moved from low growth, low return, less stakeholder focused, sprawling conglomerates to fantastic, innovative companies. This changing of the guard I mentioned is extremely important. And what it's led to is demonstrated on this chart here, on this slide here. You know, we have fantastic companies. We have global champions that there's only one thing wrong with, and that's the postcode. That's where they're listed. And the bizarre thing about equity markets, you know, we talk about growing efficiency in equity markets. Yeah, but there is huge inefficiency. And that's what Tom and I will look to exploit. And the inefficiency you can see here is high quality businesses. Actually, if we can just keep on that previous one, Tom, high quality businesses that are just the wrong valuation because they're listed in Paris, because they're listed in, you know, somewhere across Europe rather than the US. And there's some great specific examples here. So ASML, this is there's a little hotbed of semiconductor talent in and around Amsterdam, essentially. You know, these are Dutch companies. They've been fantastically innovative for years. Without going into too much tech detail, ASML produces something called an EUV machine. This is like a massive, about the size of a double-decker bus box that you could buy for 200 million euros or so, that essentially facilitates the etching on a semiconductor chip. Without ASML, there is no AI. Without ASML, there is no autonomous driving. You know, this is a business that is facilitating all of these mega trends in technology. And yet, when we look at it compared to similar businesses in the US, or adjacent businesses in the US is several terms cheaper on valuation, we want to own that any day of the week. That valuation for us, for such a quality business, doesn't make sense. Look at Novo Nordisk, which I mentioned earlier within pharmaceuticals. You know, Novo Nordisk trades at probably 10 terms cheaper, very significantly cheaper to a US company called Eli Lilly that does a very similar thing, focused on obesity, focused on diabetes. There's no justification for that in our view, other than the fact that Novo is a business listed in Europe. So these are global champions listed in the wrong postcode. That is something that with the bringing together of the two investment trusts that Tom and I ran into one larger, more liquid vehicle, we can take advantage of this. We can invest in these European businesses, and we believe that over time they will attract the same rating as their US companies. So brilliant businesses. We invest in a lot of these on this slide. Brilliant businesses, too low a valuation. Europe is still underappreciated. Europe is still the underdog, and you can see it on this slide here. You know, so it's not only, you know, the other accusation that people might throw at us is, okay, you say that Europe is cheap, but it's always been cheap. It's always been cheap relative to the US. There is an element of truth to that, but looking at the chart on the left-hand side, the valuation of Europe has never been cheaper, certainly not in our investable careers, you know, in our kind of time horizons we're looking at. So Europe has disproportionately lost out in the kind of post-global financial crisis era. And okay, some of that can be explained by the sector weightings, which you can see on the right-hand side. But even adjusting for that, Europe trades at a very significant discount. So global champions at a discount, global companies at a discount purely due to the listing location. And Tom and I try our utmost to take advantage of this. I'll hand back to Tom and we'll talk about some themes now.
Thanks, Jamie. Before I move on to some of the themes that help to just draw together some of the individual stocks that we invest in and how that fits into this theme of global champions, how we benefit from some very profound global multi-year developments underway. A colleague of ours yesterday said that a client of his in Latin America last week used the phrase, Europe regulates what the US innovates. And again, just to, you know, give a sense of how global asset allocators regard Europe as a region. And, you know, as you've just heard from Jamie, our argument is that when you get under the hood, and you actually get into the opportunity set, you can find innovation. You can find genuinely competitive world-leading companies. The first theme I'm going to talk about is an extension of what Jamie mentioned there with respect to ASML. Artificial intelligence is obviously the topic du jour, and rightly so, because it's going to take everyone's jobs everywhere. That's a joke, by the way. I'm sure it will be far more nuanced than that. But this is a bit of a map of how we get to invest behind AI. Now, the companies, the logos you see along the bottom of the slide are all of the ways that we can gain exposure to this theme through European listed companies. And I think what's interesting from a why Europe perspective with respect to this slide is the following. The lack of big tech, as Jamie mentioned, again, has been a challenge to buying Europe over the last 10, 20 years or so. Again, it's one of the counter arguments to entertaining the prospect of investing in Europe. It's why would I invest in Europe when all of the big tech companies are in the US? That's where the innovation is. Europe does not provide me with access to these highly innovative, high growth, highly profitable companies. And that was fair, I think, but something very significant has changed now, and it relates to the capital intensity of these companies. They used to be very, very capital light, but now they spend hundreds of billions of dollars every year to build physical facilities and put physical stuff in those facilities, which means there's a big supply chain trade that we can access through European listed companies. And that's exactly what we're doing. So you'll see on the top right of this slide, we talk about over $200 billion of capital expenditure per annum coming out of these 5 companies you see there on the left. So it's Amazon, Apple, Google, Microsoft, and Meta. So these are the hyperscalers. These are the guys building data centers like there's no tomorrow in order to be able to provide artificial intelligence ready cloud computing capacity to their client base. And it's a bit of an arms race. And ultimately, that's why over the summer, you've had a bit of a wobble in the tech space, because there's been some concern that it might be getting a bit bubblicious. You know, we're getting into bubble territory, all of this money. What is the return going to be on this capital expenditure? We think that argument is far too premature. And actually, I think that narrative was crafted around something more basic, which was a hedge fund driven rotation sell-off in these stocks over the summer. Short-term market fluctuations are very common. They're increasingly pronounced, and there's something for a closed-end vehicle, a trust like us, to take advantage of. We're going to come on to that a little bit later. But as I said, the amount of money being spent on data centers is not going to slow down. In fact, it's accelerating. The results and the earnings calls from the likes of Microsoft over the summer actually pointed to increasing estimates for how much money would be spent on data centers in the coming year. This is a multi-year trend with huge amounts of money being deployed. And maybe just before I go into the companies, one way to think about this is that these hyperscalers, your Microsofts, your Googles, your Amazons, at worst are turning themselves into telco companies. You know, Jamie mentioned the telco sector as slightly commoditized, a low return on capital company, but very capital intensive. You know, huge requirements to invest annually in physical infrastructure. The worst case scenario, I think, for these hyperscalers, these US big tech companies, is that they start to look more like these telecommunications firms. In other words, they have to spend huge amounts of money every year on physical stuff to keep the asset base going. And a couple of stats just to underline that. 10 years ago, Microsoft had total carrying value of its property, plant, and equipment on its balance sheet. So where the accountants say, what is the total value of all the physical stuff this business owns? 10 years ago for Microsoft, it was $14 billion. Now, as of June end, so the end of their financial year, that's now $140 billion. And what we've seen in the interim, while physical stuff has multiplied by 10 times in value, Microsoft's sales have trebled. So the sales have grown less quickly than the amount of physical stuff they carry on the balance sheet. And so what we've seen is annual capital expenditure for the likes of Microsoft go from about 6% of sales 10 years ago to now 18% and pushing 20% really. So the capital intensity of these companies has multiplied, and that means there's more money flowing down the supply chain to the companies that we invest in, and that's the opportunity. So what was a headwind to European fund managers because they couldn't own any big tech, these companies didn't spend huge amounts of money on their supply chain, has now become a tailwind. It's now an opportunity. We get to go, well, I don't know whether Microsoft, I don't know what return on capital Microsoft generates from building all this stuff. But what I do know is the companies in the supply chain will make a hell of a lot of money out of that capital expenditure. And so if we just have a quick run through of how we're accessing this supply chain, we can go heavy basic materials, so CRH and Holcim, 2 European-born aggregates and cement companies, both with very large US presences, by the way. In fact, CRH is about 70% US these days, the biggest heavy materials business in the United States economy. You need to do a hell of a lot of subsurface infrastructure development when you're building a data center. So that's lots of aggregates, lots of cement, storm drainage systems, routing systems for power, and so on. These companies get the benefit of that, and we're already seeing it in their order books, which are still growing in volume, in value, and in margin. It's highly profitable work for these guys when they do the shovels in the ground, the basic work on these data centers. If we go into the industrials part of the supply chain, Schneider and Siemens, again, French listed, German listed, but global in their presence, both have leadership positions in kitting out these data centers with various forms of hardware and the software that actually manages these facilities. So it's power management systems, power backup systems, and everything even down to your fire and your sort of hazard safety equipment. Their data center businesses are growing about 30% compound at the minute because of all this money that's coming down the track from these hyperscalers. And then finally, as Jamie mentioned, we've got a really rich ecosystem in the Netherlands of semiconductor innovation, and what a lot of these guys do, ASML being the poster child, but there are some lesser known global champions within that ecosystem, a lot of it based around Eindhoven actually, is equipment. So they sell the machines that the likes of Taiwan Semiconductor buys to put in their factories, and they produce the chips on behalf of NVIDIA. So obviously we all know NVIDIA because it's, well, not only the poster child of AI, but it seems to be the poster child of the global stock market at the minute as well. And just yesterday, it got back to within a whisker of its all-time high. So it's bouncing back very strongly, but NVIDIA doesn't produce its own chips, it designs them, and it outsources the design, or rather it outsources the production of those chips to the likes of Taiwan Semiconductor. Taiwan Semiconductor then has to build the factories and buy all of the best, latest chip-making machinery, and many of those roads lead back to the Netherlands. So that's a cross-sector description of how we access the monster theme that is big tech capex that will be multi-year in duration. Now, the final thing I would mention here is we're able to do this consistent with our remit to be a core or style agnostic proposition for shareholders. So this is not just a fund that is jam-packed full of the most expensive growthy tech stocks. We're able to do this in a really nice, diverse way across valuation attributes. And so despite the really sound performance of CRH and Holcim over the last year, the last 3 years, in fact, they've been some of the biggest contributors to the trust performance, but they're still trading on, well, it's 7% free cash flow yields. That's pretty cheap for the level of earnings growth and earnings visibility that they have. Likewise, Siemens, you can buy that for about 7 or 8% free cash flow yield right now. Again, that's a value stock, really. Schneider, you pay up more for, and of course, the semiconductor capital equipment names, you pay up quite a bit more for. Although they've had a bit of a sell-off over the summer, as I mentioned. But ASML, you would expect to have to pay up for an ASML because it's going to print 25% earnings growth for the next couple of years. That is a growth rate that commands a higher multiple, but we're able to fit that in to a portfolio that comes through much more blend with a nice mixture of some cheaper stocks and some more expensive stocks. With that, I'll hand over to Jamie for some more themes.
I'll whip through these a little bit just so that we leave enough time for Q&A. The main message for us on this slide here is that if we go back to the zero interest rate policy years, the ZIRP years, the pre-COVID time when funding was cheap, irrational funding was everywhere. Big companies were kind of struggling a little bit with the small, unprofitable, nascent companies nipping at their heels that bit more. There was, in our view, an irrationality to the market. Interest rates have gone up, and we don't believe we're going back to the ZIRP world. We're not going back to zero interest rates. So we're in a new funding environment, a new funding paradigm. And in this one, it is a bit more difficult for small venture-funded businesses to reach market and to reach relevance. Venture funding, for example, was down 60% in 2023 compared to 2022, bringing it to a 6-year low. So in this environment where there are some rates, there is a bit of inflation, scale matters, big is beautiful. The smaller companies suffer more from rates being higher, from costs being high, and see a P&L squeeze. Some of the things we talked about, tech, AI specifically, it needs scale. You need to have the capabilities of a large company's balance sheet to be able to invest behind AI. So big is beautiful. We can see many reasons or many explanations of that within different sectors. In beer, for example, a subject that Tom and I are quite in favour of in the portfolio as well as in real life. There are, we went through a period where, every man and his dog had a small little brewery that was popping up somewhere. We're now back in a world where you need to be AB InBev. You need to have local scale. You need to have big breweries that take advantage of the natural fixed costs involved in brewing beer. Irrational funding's over. Food catering, other example. Pharma, another example. It is no coincidence that one of the largest companies in Europe has found an efficacious solution to obesity rather than a startup. So big is beautiful, and that is why at the moment we're quite biased towards large companies within the portfolio. Tom, if you flick onto the next slide, I'll be very brief on this, but the point I want to make is that we have to be active, we have to be flexible. Tom and I need to be people who will change our minds when the environment around us changes. The blue period in the middle of this chart, this shows the ECB, so the European Central Bank interest rates over the last kind of 20 years or so. And you can see in the middle, we had this environment that I just referred to, the ZIRP period, where interest rates were nothing for a long period of time. And fund managers, our generation of fund managers, have kind of grown up being accustomed to this. It is not the status quo. It felt like it for a long time, but it's not the environment we're in now. Rates have risen, rates have come up. They're going to go down a bit. At the moment, we're in a rate cutting cycle, but they're not going back to zero. Inflation is here to stay. That determines the kind of things that we are looking at and the kind of things that we'll try and take advantage of. And when I think about the kind of investments that worked over that zero interest rate policy period, the small companies, the unprofitable companies, the tech companies that didn't have any revenues, that is not the areas we're looking at today. That is not the areas that Tom and I are looking to invest in. And we can touch on that maybe in Q&A. And I'll hand back to Tom just for a final slide, and then we'll touch on some questions.
Thanks, Jamie. I'll be much quicker on this one. I already alluded to it. Markets are bedlam. It's absolute chaos on a daily basis out there in the market, and it's only going to get more chaotic. What we've seen is huge growth in short-term money, so hedge funds, quant funds, CTAs, often that deploy significant amounts of debt on top of their equity into the equity markets, to the extent that active long-only investors such as ourselves are now only about 10% of daily volumes. What does this mean? Well, it means things can be very, very volatile in the short term, because for many of these hedge funds, it's the month-end performance that they live or die by. Likewise, on the algorithmically driven strategies, there are various momentum-related triggers that become self-fulfilling. When markets start to sell off, these funds trigger stop-loss mechanisms that takes the leverage out, and so they sell more. And so, as you saw over the summer, ASML, one of the biggest companies in the European equity market, sold off by 30%. That is really, really extreme, and it relates to the market structure. So what we would do here is we would highlight that you should expect continued chaos in the short term. You should expect that in response to quarterly results, the stock-specific reactions can seem quite irrational, quite outsized. It's all a function of the market structure and its dominance by short-term and passive money. That's an opportunity for us, especially with the luxury of this closed-end vehicle that Jamie and I are running on behalf of shareholders. When we get these outsized sell-offs, we can use our time horizon advantage to buy more. We can be more patient. It's a huge advantage, and we really want to we want to fully exploit that. In partnership with that, what we've not mentioned, and so I'll finish on this, is the other advantage that I think we have, the other edge that we have given this market structure, and it's access to management teams. It's time in the room. Our desk, I mentioned the European equity team. In 2023, we conducted 1,300 meetings with management teams. It'll be about the same for 2024 as well. We get time in the room, one-on-one time, because we're a big book of assets at a big institution. Again, we compare that with our time horizon advantage to fully exploit the madness that is today's stock market. And with that, let's pause for some Q&A.
Thanks both. I think you can take it as somewhat flattering that there's two former European equity fund managers watching this, so don't try and feel any pressure from that. The question, one of the questions that's arisen, in fact, there's two questions, I think we can connect them. Shareholder in both the predecessors asking about how much of, you mentioned this at the top, the value. I think it would be an exaggeration to say Heft was a value-oriented trust, but you know, it certainly took value opportunities, Tom, and so there's a question about how much of that will carry across, and then perhaps that links to a more specific question about opportunities in commercial property, which I know you have been looking at recently and perhaps could be categorized as somewhat a value opportunity.
Yeah, so shall I take the first half on the Heft DNA and how much of that is carried forward, and then Jamie should absolutely talk about the real estate opportunities. So you're right, it is an exaggeration to say that Heft was a value fund. I think what distinguished it was that it wasn't a dogmatic growth fund during the ZIRP era. It was style agnostic. You know, ultimately, our desire was always to be a core all-weather fund that would outperform the benchmark during any market regime. But by not being, you know, if you think about those Morningstar analyses where you've got the grid system, the top right would be large cap, mega growth. We were always left of the peer group. So we became seen as the value guys, and that lives on. You know, I can embarrassingly state that just in recent weeks we've bought Bayer, and that was me instigating it, and it's actually down 5% today on some more litigation stuff. So for my sins, I still like a value opportunity. Bayer is so ignored, so beaten up, down 70% in the last 5 years, but with maybe some signs of things getting a little bit better. You know, that's classic Heft, and it very much lives on.
Thanks, Tom. And then, yeah, onto real estate. So, or property, as put in the question. So, yeah, super interesting. You know, in theory, we talked earlier on about market paradigms and about interest rate cycles. You know, we're in a period now where, yes, interest rates are coming down. No, they're not going to go back to zero, but they're coming down. That is generally an interesting environment for property, actually. So we quite like the fact that we're in this part of the cycle to then look at commercial real estate. And we found a number of interesting businesses across continental Europe. But we actually couldn't find anything better, or to link into Tom's previous question, as good a value as an opportunity sitting right here in London. So we've actually invested in British Land. Now, we can kind of think of the portfolio as three-quarters kind of London office-y kind of style, city-based kind of exposure. And then they've got retail parks as well, which are the only part of kind of consumer property that we're seeing growing square footage at. You know, so people like the convenience, especially in a click and collect world of driving up to a retail park and going and returning and buying product from. So that's a really good business. And partly because of Brexit, partly because of where we are on interest rates, partly because of the kind of, I don't know, this antipathy towards the UK that's still present, this business trades at a 30% discount to NAV. So yes, we like, and we're starting to like that sector, and we found it in a UK name rather than a German name or something else.
Yeah, thanks both. There's another question about going back to this kind of core point that European equities as a group are this valuation discount. Obviously in London we've seen a steady stream over the years of companies moving to New York to get a higher valuation. And do you see a risk of the same thing developing? Would it really make a difference to the trust? And kind of more generally, are you seeing the kind of associated activity that comes with valuation discounts, like M&A, and also with markets perhaps having a slightly more positive tone? Are you seeing the other sign of life, the IPO market, coming back into play?
Okay, so I think, yeah, let's break that down into three. I'll take the US or the corporate action side of things, because we've got CRH, which is a prominent example of such behavior. Then we've got M&A. One of the things Jamie mentioned there with respect to big is beautiful is we're seeing bolt-on M&A increase by some of these big players, but you can talk that certainly. And then the final one was, remind me again, there was another leg of the question.
Just to ask if you can see any signs of, another side of stock market health is IPO market. Yeah.
And Jamie should do that. He led us on a couple recently. So with respect to this discount versus the US, we've had a couple of prominent examples of companies saying, fed up, I'm moving my listing to the US. CRH has moved its primary listing to the New York Stock Exchange. It collapsed its Irish listing, but it retained London as its secondary listing. And that is the line that we own. So we are hopefully participating in that re-rating journey for CRH being primarily listed in New York via the London listing. We thought there was a decent chance at the start of September that CRH would get added to the S&P 500. It didn't. It's a bit opaque, actually, the process of selection. It's done by committees behind closed doors. And in the end, I think it was Palantir that went in to the S&P 500. But that means CRH is now the biggest market cap company in the US, sat outside of the S&P 500. So we think that'll be an extra boost to the rating. CRH is still about 30% cheaper than its direct US peers, Vulcan Materials, Martin Marietta. So that's one route they can take. And look, if we can retain a secondary listing here in Europe, that's fine. We can go on that journey with them. Some less extreme measures include, let's say, the likes of Total, the French listed oil company, again, pretty miffed about their rating relative to Chevron and Exxon. Shell's the same. What they do is they focus a lot of their investor relations activities towards the US to get those US investors onto their shareholder register. And so Total has been successful in getting over 50% of its institutional shareholder ownership now US-based. Total will be a little bit more hamstrung because the French are very sensitive about any talk of moving listing status, and that indeed happened with Total about 6 months ago. Shell, similar. CMDs are hosted in the US. The CEO's time on investor roadshows is prioritized to the US. They are making a few more noises about potentially moving a primary listing to the US in time if this process of cost-cutting, huge buybacks, boosting dividends doesn't result in a narrowing of the gap towards the likes of Chevron and Exxon. So it's a mixed bag, but in many cases we can benefit from that. You know, it's not a wholesale de-equitization of the European opportunity set. And then Jamie, on M&A and IPOs?
Yeah, sure. So again, a mixed bag actually here, and I think it's very hard to have an overriding message to give you. So on the IPO front, I would say sporadically there's been moments at which companies have managed to IPO. There's been small windows of opportunity. There's not widespread exuberance. If you go back to 2020 and 2021, in those ZERP years, again, IPOs were all over the place. You know, a lot of different businesses listing in a lot of quite spurious areas. You know, now the deals that come to market tend to be smaller and tend to be better quality companies. So we've participated in a couple so far this year. One was a fragrance company. The other was a kind of Swiss derma cosmetics company. So there is bits of activity there. In terms of M&A, again, nuanced. We can see there is bolt-on activity happening, but what we tend to see is that in sectors where public valuations exceed private valuations, we see bolt-on M&A happening. So good examples would be we own a Swiss testing company called SGS. They're consistently able to buy businesses at valuations lower than their own, and so they do so. DSV, another business we own, freight forwarding business, we've recently supported them on a large acquisition. So there's bits and pieces happening. On the other side of things, there's some areas of the market where private valuations exceed public valuations. Those are obviously areas we kind of tend to be interested in from a valuation angle. And a good example is in the telecoms towers industry, where we're seeing companies like Cellnex at the moment are far more in the mode of selling companies because of the prices they can get on the private market for those businesses versus public market. So nuanced, that's kind of the day job for Tom and I, to think about these things and the opportunities, and no clear message across those three things.
Yeah, and there's another question which I don't think will really surprise you, but I think it is a rather central question. Obviously, geopolitics is worrying investors, and you know, there's a land war in Europe, and it's hard to read what that means. But do you think I don't want to put you in a corner, but do you think that the valuation discount can be partly explained by that? And do you think there's cause for investors to still be cautious about this?
Yeah. Maybe Tom, if I just start on this one, and then I'll hand over if you have anything to add. So a few things to say. Firstly, geopolitical events are very difficult to kind of invest one way or the other around. And generally, what we're trying to do is ensure that in any particular area of geopolitical focus, we're not going to be hopelessly offside if something bad happens, or if there's a good result, so to speak, you know, a resolution to something that's happening. So a good example is, you know, rising tensions in the Middle East. You know, obviously horrible to see for all of us. We've got to think about how we protect our portfolios with those things going on. And the way we've done it is to ensure that we have a bit of a hedge in the portfolio through oil exposure, and we have some defense exposure. But as I say, you know, these are pure portfolio considerations. Clearly, from a kind of moral and societal perspective, we're quite appalled by what's going on there. One of the bigger things for us would be to look at China. I think the influence that China has on Europe is pretty profound. You know, Europe is the most sensitive Western region in terms of revenue exposure to China. So we have to have a view there. We have to think about what the PBOC are doing with fiscal policy. We have to have a view, and we have to try and make sure that our portfolios are exposed in the right way. So, bit of a rambling answer. Tom, not sure if you have anything to add to that.
Yeah, just a couple of thoughts. Jamie mentioned some of the risk management tools that we take with respect to geopolitics, so oil and defence, very, very obvious ones there. And that's protected us over the last couple of weeks as we've had an escalation in the Middle East. On a longer term basis, it is consistent with a kind of longer term framework that we often talk about. Actually, we didn't put a slide in this particular presentation, but it's this multi-year CapEx super cycle. We talked about the AI component and that, and semiconductors and all of that stuff. But this shift to a multipolar world, it leads to an increase in capital intensity everywhere because we're seeing deglobalization. One of the reasons the US is running over a 7% budget deficit and has various fiscal stimulus programs across public infrastructure, semiconductor, autonomy, renewable energy supply chains is all part of this shift to a multipolar world and an expression of America first. So to the extent that we continue to see geopolitics increasingly fraught, it is consistent with that long-term framework of countries are going to have to spend more money to onshore more of their critical supply chains and ensure resilience in areas. One final thing I would say here about, you talked about the valuation disconnect in Europe and maybe that being driven by geopolitics. I think it's been more driven by US dollar strength and US dollar, or rather higher US interest rates being a driver of that. As US rates come down, it leads global asset allocators to look a bit further afield, so that might help. It's not a prediction, it's certainly not a 6-month trade that I'm advocating, but that can help. And one of the first potential iterations that we've seen of that relates to China, what Jamie's just said. I don't think it's a huge surprise that China has come out with a series of monetary and fiscal statements now that the US has started to cut rates. And if we think back to the last time China's pain threshold was reached in late 2015, early 2016. So I was covering the mining sector at the time and a bunch of them nearly went bust. But then the authorities' pain threshold was reached. First, it was capital controls, then it was monetary, then it was fiscal. This time, the US rate cutting cycle beginning is a form of capital control for China. It relieves pressure on the currency, frees them up to be a bit bolder on the monetary side of things. And just as a sort of near-term outlook for listeners, what we've had this year, or certainly over the last 3 to 4, even 5 months, is a lot of negativity in the market. So defensives, so those with predictable revenues and earnings, have significantly outperformed anything that's seen as more economically sensitive, and especially anything that is economically sensitive and directly or indirectly exposed to China. Even just a couple of weeks ago, the level of negativity around China was extreme, talks of Japanification and so on. Just in the last couple of weeks, we've had China blinking and starting to signal more support for its economy. And we've actually had a pretty strong US jobs report. Look, it's one data point, but it suggests that the environment for the global real economy might incrementally start to look a bit better from here. And if that's the case, if that narrative carries through in the market, we're probably going to see a catch-up in those more macroeconomically sensitive stocks versus those defensive stocks. And this trust is well positioned to benefit from that. We've just closed our year end as of 30th of September, and we were, I think, about 1.6, 1.7% ahead of the benchmark. But that includes actually a bit of a give back over the summer of some performance as cyclicals. Everybody fled cyclicals and bought defensives because they were worried about US recession, Chinese Japanification. We are maybe in the early stages of a bit of a narrative shift there, and that will benefit our positioning.
Yeah, thanks, Tom. I think a good place to wrap up is that there's a question. One of the viewers notes, obviously you still have a European equity investment trust, stablemate European Smaller Companies Trust, with a very respected manager with a great track record. And so can you comment specifically on how you work with him? But it's probably a good opportunity just to talk about the general team dynamic. And obviously you mentioned earlier that you bought a UK stock, so how you interact with the rest of the floor.
So Jamie, do you want to kick off?
Yeah, shall I take this? Yeah, sure. So a few points. So firstly, we are very much mid and large cap in this investment trust. So we will go mid cap, and at the moment we're pretty heavily biased towards large cap. That's our universe, really. So the small cap side of things, as the listener has quite correctly pointed out in his question, that really is Ollie's territory. So small cap, we won't really get involved in. However, there are a number of different sectors, a number of different themes that have immense relevance across the market cap spectrum. So what Ollie has to say about let's say a small equipment company that feeds into the valve equipment chain has huge relevance to us when we think about that group. So there are, he's invested in businesses that supply to ASML. So there are huge overlaps in our research, and everything we write or think about a company is kind of put on a central system that everyone can access. So we can see the work he does, he can see the work we do, and we exchange ideas and thoughts all the time, informally and formally. So that is a very, very useful relationship. Similarly, on the UK side of things, we've got a very strong relationship with the UK guys. They sit a few desks away from us, and we will debate and discuss ideas all the time with them. British Land, the example I gave, actually gave us a very welcome opportunity to go and talk to Guy Barnard, who we know very well, very nice guy who runs our property equities team. So there are numerous occasions for us to speak to people within London, across our desk, a little bit further afield, and even in Denver, where there's a team of analysts. And we will use those opportunities as often as we can. I think informally, the interaction between us and Ollie mainly tends to involve Ollie mocking us for owning companies that he used to own a quarter of the PE valuation, or so he says. But yeah, we get on very well and exchange ideas all the time.
Yeah, I think that dynamic comes across quite clearly. So thanks both for your time. We've taken the full hour. I was just saying there are a few questions we didn't manage to answer on a more technical basis. There's a great website with a lot of information. And of course, there's also the Kepler website where you can find other information. And so with that, I'll thank both of you for your time today, and thank everyone for attending and for sticking around for the full hour. So we'll see you on the next one.
Thanks, everyone.
Thanks, guys.
All the best.
Thanks very much. Thank you. Bye-bye.